Good evening, everyone. My name is Ntando, if you don't know, and today we will be looking at the income statement and its adjustments. I've been getting a lot of requests for this video in particular because it seems students have forgotten how to, calculate or tackle the adjustments that come with the income statement. Well, I have a question here that I'd like to do with you guys, and yeah, let's get into it. Well, obviously, comment, like, share, subscribe, and this time I will be sure to upload more videos and grow the channel, and obviously get better equipment. But yeah, gems are being dropped here, and it would be very beneficial to you if you stay for the video. Okay, let's begin. So we have we have the information relates to the financial year ended 31 March 2019. So that's very important because, I always tell my students you have to know where, when the year starts and when it ends. That's the first thing you do because there's a lot of adjustments that, deal with time frames and whatever. So now we have 4.3.1 says complete statement of comprehensive income statement for the year ended 31 March 2019 for 53 marks. Yes, a lot of marks. Well, we have the information given here, and the figures and all the good stuff. All right. So obviously I did not bring the answer book because it's very crucial to swat off, or rather memorize, the structure of the income statement. So we have this situation here. So you have your sales, cost of sales, and then you have your gross profit. All right, let's make it here. As you know, you put brackets there, gross profit, and then you have your operating income. And then we can't go further because we don't know how many items are there. But as I'm saying, it's very important to understand. Now, let's begin. We have the adjustments here. The first one says a credit invoice for 36,000 Rand, 36,720, after deducting a 10% trade discount issued on 31 March 2019 was not recorded. Goods are marked up to 70% on cost. Now, that one is not particularly an easy one because I'll show you exactly what I mean. So we have adjustment number, letter A, we have the amount of 36,720. Now, there's a method I'm sure you guys are familiar is, and it's called amount times unknown over the known, or this is want over have. I think people understand it better that way. I hope you guys can see. So amount times unknown over the known, or want over have. So this 36,720, this was after the deducted amount or percentage of 10% was made. So this, we are looking for the full amount. So this represents, remember, unknown over the known, or want over have. We want the 100%, but we have the 100 minus 10%, which is 90%. All right. And then you punch that into the calculator. 36,720 multiplied by your 100 over 90. you have 40,800. That's the full amount that we're looking for, because we're looking to work out the cost of sales from that. All right, so now, since we were told that goods are marked up at a 70% on costs, so we take that 100 over 170. So answer multiplied by 100 over 170, and you get 24,000. 24,000. That's our cost of sales. Now, how would you do that? Remember, a credit invoice, it's a sale. You're selling goods on accounts, selling goods on credit to your customers, to your debtors, right? So obviously your sales increases. So now we go back to our, the pre-adjustment trial balance. We look for the sales amount of the previous year. Well, we have the sales there as 10,563,280. So it's 10, open your brackets, 10,563,280. So since we made a sale, a credit sale, you add the sale amount, not the cost of sale. So it's 36,000. Remember, it was omitted, so that's why we added 36,720. And then for your cost of sales, and then according to this information, we have a cost of sales of 6,236,000. And then you're just going to write that here, 6,236. And then you add that because our cost of sales is increasing. 24,000. Cost of sales is an expense, expenses are increasing. All right, I hope you guys understand. Very easy, very straightforward. And then now we move on to the next adjustment. Now it says here, a physical stock count on 31 March 2019 revealed the following on hand. Now these amounts are very useful when you calculate, especially the trading stock. They're very useful when calculating your trading stock deficit or surplus and your note for inventory. You use that information for your note for inventory. So for now, we're not going to do anything with that. So remember, you have to do a full analysis of this. So your trading stock decreased by 24,000 Rand. That's what you have to take note. Now it says, information C, debtor S. Magnum was declared insolvent. His estate paid 2,000 Rand, which was 20% of his debt. The difference must be written off as a bad debt. Right, that's easy. Remember, this method, I always stress this method, you're going to use it a lot throughout your accounting, paper 1 and paper 2. So yeah, get familiar with it if you don't know it, and if you do, well, that's very good. Now we have information C saying we debtor paid 2,000 Rand. Now we need to use this because it says he's declared insolvent, so obviously he can't pay off his debt. We have to write him off. His estate paid 2,000 Rand, which was 20% of his debt. The difference must be written off as a bad debt. So the difference is 80%, right? So 1 over half. What we want is the 80%. What we have is the 20. All right. So 80 over 20, which is 4. 2,000 Rand times 4 is 8,000 Rand. And if you want to check with the calculator, that's very much okay. So we have 2,080 over 20. We get an amount of 8,000 Rand. Now that's what's supposed to be written off, because the difference is what we write off, right? Difference, we write off the difference as a bad debt. You see, so this is how you should obviously tackle these questions. Analyze each question thoroughly and properly, and then you just go on to your answer book and just fill in everything that's missing. That's how you just do this. Now let's move on to the next one. Information D says 1,800 Rand was received from debtor J. Misting, whose debt had previously been written off. Now, for as an accounting student, that term immediately tells you this is a provision for bad debts. But what? Not provision for bad debts, but it's a bad debts recovered, right? So that term, previously written off, immediately should alert you that that's a bad debts recovered adjustment. All right. So the bookkeeper incorrectly credited the amount to the debtors control account. Correct the error. So, what's the idea? Any ideas? No, it's very easy, very straightforward. Now, that 1,800 Rand, when you credit it to the debtors control account, now, analyzing information D, we have your debtors control. All right. This is an asset, increases on this side, decreases on that side. It was credited, so it was decreased by 1,800 Rand. So you have to actually cancel this. All right. You bring it to the other side. That's how you do it. And then record this as a bad debt recovered. I hope you guys understand. It's very straightforward. All right. So let's move on to the next one. Information E, adjust the provision for bad debts to 28,500. Now, all you have to do for this one, your analysis comes information E, you just compare. So now provision for bad debts, what you're providing for, you're setting money aside, basically. So this is sort of an expense, if you will. Now, all you have to do, you have to just look here. You have your provision for bad debts. There in 2018 is 30,100. So 2018, 30,100. And then we have to adjust it to, in 2019, we have to adjust it to 28,500. Now, you just take the difference, which should be 3,100 minus 28,500. It's 1,600. You have your 1,600, and that's a provision for bad debt adjustment. Now, if you're setting less money aside in the following year, does that not become an income, the difference? So think of it this way. You setting money aside of 30,100. So that's an expense to you. But next year, you're setting money aside, so you're decreasing your expenses. So that when you decrease that expense, the difference becomes the income. So this adjustment goes under your operating income. All right, hope you guys understand. And then let's move over to the next piece of information, which is if insurance includes an annual premium. So annual 12 months of 51,000 Rand paid to for the period 1 Jan 2019 to 31 December 2019. Now, Remember, there's 4 items. There's deferred income, accrued expense, and prepaid expense. It falls in one of those categories. So insurance, that's an expense. It's been paid from 1 Jan 2019 to 31 December 2019. So that's 12 months. Now the problem here, our year ends in what? 31 March. So our year ends in 31 March 2019. So this is for information. If year end is 2019, 31st of March. So we have a couple of months that are in advance. So you just have to count. So it's Jan, Feb, March. It's 3 months. So 3 months are within our current financial year, but the 9 months are outside. So what are you looking for? You're looking for the nine months that are outside, because this is a prepaid expense. All right? It was paid in advance because 9 of the 12 months are outside our financial year. So we have this amount of 51,000. So instead of going the long way and first dividing the 51,000 and then by 12 and then multiplying by 9, all you have to do is use the amount times 1 over half. What do we want? We want the 9 months, and we have the full 12 months. And I always say this: the bottom must always match with the top of the opposite side, because this represents this. All right, have 12 months, and this is what this 51,000 represents the full annual premium. Now we're looking for the 9 months outside of our financial year. So prepaid expense becomes 51,000 multiplied by 9 over 12. We have 38,250. 38,250. And then from the previous video of this one over a year ago, you'd understand that this is always subtracted. You always subtract the prepaid expense because it does not relate to our current financial year. It's actually a liability. All right, so now it's actually an asset. So we move on to the next piece of information, which is G. G says an employee was left out of the salaries journal for March 2019. The following details are applicable. Net salary of employees 9,100. The deductions by the employer total 30% of the gross salary. Employer's contributions were 2,200. So obviously the contributions are straightforward. What I want to talk about is the gross salary. So we have the 9,100, and yet again the 1 over half. What do we want? We want the 100%, but we have what? This piece on the second bullet says the deductions by the employer total 30% of the gross salary. All right, so this 9,100 represents 70%, which is 100 minus the 30% deductions, because this is a net salary, right? So we have the 70%, which becomes 100 times 100 divided by 70. So we have 13,000 rand. This 13, you add it to your salaries and wages expense. All right, it's straightforward. 13,000. Okay, let's move on to the next piece of information. Now it says interest on loan is capitalized. Capitalized, what does that mean? It means that every time interest is calculated, it is added to the original amount. So for example, we have a loan of 80,000 Rand for this year, and at the end of the year, we calculate an interest of 30,000 Rand. And then if you want to calculate interest for the next year, you take that 80 plus the 30, which is 110, and then you multiply it by the rate. So that's what it means. Okay? So interest on loan is capitalized. A fixed monthly repayment, including interest, of 25,000 Rand was paid for the financial year. Now, that's straightforward, but I don't know, students kind of struggle with this one. I'm not sure why. But yes, there's always a table that I always show students of how to, do this information or adjustment. So our next piece of information is H. So we have H. And then the table I always show is the loan at the beginning. And then you have your interest, repayment, loan at the end. Loan at the beginning of the financial year, interest obviously throughout the year, repayment in the middle of the year somewhere, and your loan at the end. This is the table I always show students. So if you can't do it in your head or whatever, just go back to the basics. Repayment is always in brackets. Alright, and then you have your loan at the end of the year. Now, this plus this, so this is how you go down the table. Down the table is this plus this minus that, you get that. Going up, you reverse. So this, you change the sign. And then you subtract this to get that. I hope you guys understand. Alright, so let's get started. So now they told us that interest on loan is capitalized. Yes, a fixed monthly repayment included the interest of 25,000 Rand was paid for the financial year. Now, monthly repayment of 25,400. Now, we have to go back. Now, where's the loan? We got to look for the loan, mortgage loan, Sapphire Bank, for 2019. So we have 1,430,000 Rand, 200. So now, what we're basically looking for So we record here 1 million. The loan at the beginning is 1,658,000. 1,658. Then the interest is unknown, but the repayment we know, which is 25,000, is a monthly repayment of 25,000. Hope you guys can see. Information age. So it's 25,000 Rand. So it says a fixed monthly repayment of 25,000 Rand. 25,400 was paid for the financial year. So obviously you take that 25,400, multiply that by 12. You get 304,800. That's what's going to be subtracted. 304,800. Right? And then at the end of the year, we were given an amount of 1,430,200, also 1,430,200. Now, obviously, we have to work backwards because we're looking for this guy. All right, so this working up, this plus this, and then minus this because it's a positive to find this, since we don't have this. All right, I hope you guys understand how this table works. I really hope you do. So we have the 1,458. Oh, sorry, 1,430,200. 1430200, and then obviously plus the interest, or sorry, the repayments, 04800, and then minus the 1658,000. All right, get an amount of 77,000, and that becomes your interest. Now, interest on loan is a note on its own. It's note 2. It's part of note 2. So it's at the bottom of the income statement. So this is an expense. So it's always subtracted. So 77,000 interest on loan. All right. This is part of interest expense in note 2. So don't forget the basics, guys. So now let's move on to another piece of information, which is the fixed assets. I think this is where we calculate the depreciation. Now, so an I for an I. So it says fixed assets and depreciation. Vehicles, we have the details for 3 vehicles are as follows. The cost price for one is 350, the other is 400,000, the last one is 627,000. Accumulated depreciation on the start of the financial year was 315 for the first one, and then 160 for the second one, and then we weren't given for the last one because it was purchased throughout the year. All right, okay, that's straightforward. Now it says vehicles are depreciated on 20% per annum on cost. All right, so this one is straightforward, guys, because you don't have to work with a diminishing balance. So all you have to do, you take your vehicles, depreciation, vehicle number 1 becomes, so we have, don't know if you guys can see, 350,000, multiply that by 20%, obviously for 12 months, so it's 12 over 12. All right, so 350 times 0.2, we have 70,000 rand, and then vehicle 2, which is 400,000, 20%, also for the full period of 12 months. .2, we have 80,000. Vehicle number 3, we have 627,000 times 20%. However, this was not in our books or in our possession for 12 months. It was only purchased on the 30th of November 2018, and the year ends in Feb. So for how many months did this car or vehicle depreciate? So it's December, January, Feb, and then March 2019. So it's 4 months. 4 out of the 12. So 627 times 0.2 times 4 out of 12. 41,000. 41,800. That's the depreciation for this particular vehicle. All right. Hope you guys cool with that. All right. Now, something I want to speak about, and you guys need to take note of. This wasn't just a straightforward depreciation question. All right, so we also have equipment here, and it says equipment was sold for 9,600 Rand cash on 31 August 2018. Only the following entries in respect of this sale were processed. So the cost price was 28,000. Accumulated depreciation of the date of sale was 21,500. Depreciation for the current financial year is 1,750. Okay, that's this depreciation is very important to note. This depreciation will be added to the depreciation that you've calculated for these vehicles. Remember, when you're doing your asset disposal or anything, depreciation is always added to your original amount. So never subtract depreciation, especially when you're doing your asset disposal. So depreciation on the remaining equipment is calculated at 92,500 after taking all of the above into account. Okay, so that's straightforward, because all you have to do, you take that 92,500 plus the 1,750, and then that becomes your depreciation for your equipment. Now, let's talk about something. This vehicle, the first vehicle, as you can see, was purchased in 2013. Now you can count how many years. So it's 1st October 2019, 1st October 2020, 1st October 2021, 1st October 2022, 1st October 20... so wait, how many years now? Oh, 2018. So 2014 October, 2015 October, 2016 October, 2017 October, 2018 October, and then 2019. So it's over 6 years this car has been around. Now, if you do the depreciation, if you look at the 315, that 315, something you guys really need to note: the 1 Rand rule plus 315,000 accumulated depreciation becomes 315 plus 70,000. $385,000. Now, do you see the cost of this vehicle is 350,000? However, its depreciation, well, its accumulated depreciation is what? Is 385,000. Yes, they told us that we should use the cost price for depreciation or the straight line method. However, it's very important to note that we work with carrying value as well, because if you take 350 minus 385, you get a negative value. So obviously we don't have that in accounting. You can't depreciate anything to a negative value, so you bring it to zero. How do you do that? Well, all you have to do, you say 350,000 minus 1, because you're bringing it to 1. You can't bring it to a negative value or 0. No. Since the let's note that the accumulated depreciation is higher than the cost price. You depreciate the asset, you bring it to 1. You bring the carrying value of the asset to 1. That's very important. When accumulated depreciation is larger than the cost price of a vehicle or an asset, the asset, the carrying value of the asset should be brought to 1. So this is the carrying value. That means the depreciation becomes 34,999. I hope you guys understand. Always take note of this. Well, especially, in the income statement, they know that you guys have been doing this for the past 3 years. They have to bring in some, tricks here and there to see if you guys will notice. Because if I'm not mistaken, this is something you were taught in grade 10, the 1 Rand rule. Anyway, so yeah, that's your depreciation. You take this plus the 41,800 and then plus the 80,000. Forget about this 70,000 here. it's irrelevant. Hope you guys understand. All right, so moving along. All right, so let's move on to the next piece of information. So we are on this side. All right, so it says interest income is the missing figure in the income statement. Okay, that's easy. So income tax is calculated at 20%, 28% of the net profit. The net profit before tax was 691. All right, so obviously, so for information K, what you do as a student, it's also pretty straightforward. You take the 691, and yet again we use this 1 over half. You see, there's going to be a lot of proof of this method. A lot of it, and there was it was not in this paper, but there's a particular rent income adjustment that I would have loved to show you guys how you obviously tackle that. Now it says income tax is calculated at 28% of the net profit. The net profit before tax was 691. All right, so this is easy. You just take your 28%. We're looking for the 28, and then that's it. All right, income tax is calculated 28% of the net profit before tax. So 691 multiplied by 0.28, you get a value of 19348. I hope you guys understand and are sorted with that. And then obviously from there, you record all of this, all of this information into your income statement. All right. So yeah, this is part 1. I'll come with part 2 next time, where I clearly indicate and explain how we got this amount. So again, I will be more consistent in posting videos, so please be sure to stick around, comment, share, subscribe, especially comment. Talk about where you are having difficulty understanding the concept or the adjustment. But yeah, with accounting, it's very important to read and highlight as you read, to not miss any information or have a misinterpretation of a certain statement or adjustment. Right, see you in the next one.